Big news for SCHD investors. The March 21st rebalancing is coming, and it could completely shake up the fund's holdings. Some major stocks might be out, while new powerhouses could be taking their place. And that could change everything for dividend investors like you. Imagine this. One day you're holding stocks like Home Depot and BlackRock inside SCHD, and the next, they could be gone. And in their place, potentially Procter & Gamble, Devon Energy, or even ExxonMobil. These shifts could impact dividend payouts, risk levels, and long-term returns. So knowing what's happening before it happens is critical. That's exactly why you need to stick around, because in this video, I'll break down how SCHD selects and removes stocks. It's not random. The potential companies on the chopping block, what new stocks could be added, and why it matters to you. The impact this could have on SCHD's performance and dividends. And most importantly, what you should do right now to stay ahead of the curve. Stay with me till the end and you'll know exactly what to expect and how to position yourself for success. Let's dive in. SCHD is about to shake things up. Here's what you should know. Over the last couple of years, SCHD has stayed relatively unchanged, yet I strongly believe it should still be a key piece in most portfolios. I've been steadily buying in no matter the market conditions, and I have no plans to stop. But here's the exciting part. Big updates are coming. SCHD is about to rework its portfolio, and these adjustments are set to enhance its performance. If you already own shares, prepare yourself. If you haven't jumped in yet, this might be your moment. The official reshuffling happens on March 21st, and once the news circulates, expect a surge of fresh investors. SCHD remains one of the strongest dividend-focused ETFs, known for reliable income, steady expansion, and minimal risk. Lately, it's taken a backseat as investors chase tech-heavy funds, but that's because SCHD avoids high-growth tech stocks like Nvidia, Palantir, and Microsoft. While those companies have soared, SCHD has remained stable and dependable. But with these upcoming shifts, things could look very different. SCHD's track record: steady growth with less risk. Taking a step back, SCHD has proven to be incredibly reliable, delivering an average annual return of over 11%, which is absolutely remarkable. That means it has kept pace with the S&P 500, but with far less volatility, making it a lower risk yet high reward investment. Count me in! To keep this momentum going, SCHD is about to revamp its holdings, and the reason is simple: to maximize returns for investors like you. Each year, SCHD undergoes a portfolio reset, carefully removing underperforming companies that no longer meet its strict criteria. At the same time, it adds top-performing businesses with strong growth potential, ensuring investors benefit from the best stocks available. This process is common among well-structured ETFs, and that's exactly why I strongly recommend investing in ETFs overall. With an ETF, you don't have to analyze every single stock, track market movements, or stress over when to buy or sell. A solid ETF handles everything for you, filtering out weak companies and optimizing your portfolio automatically. Some argue I can do this myself. Just sell my losing stocks and reinvest in better ones. But here's the catch: tax consequences. Selling individual stocks, especially after gains, can trigger tax liabilities. Beyond that, there's the emotional challenge. How do you know if a stock is truly failing or just experiencing a temporary dip? By investing in ETFs, you eliminate that mental strain and let the fund do the heavy lifting. So what exactly is changing in SCHD's lineup? At present, SCHD is made up of 102 different companies. When you invest in SCHD, you're essentially securing a small ownership stake in each of these businesses. This is why any modification to its lineup is a significant event. As of now, SCHD's largest holdings include AbbVie, Coca-Cola, Cisco, Amgen, Pfizer, Chevron, Verizon, Texas Instruments, BlackRock, and Home Depot. If any of these major corporations are removed, it would cause notable changes within the fund. On the other hand, if smaller allocations like Central Pacific Financial or Ethan Allen, which each make up merely 0.03% of the portfolio, dropped, the overall effect would be minimal. So how exactly will this adjustment process unfold later this month? And what guidelines does SCHD follow when determining which companies to retain and which to eliminate? You can find all the specifics on their official site. SCHD is designed to mirror the Dow Jones U.S. Dividend 100 Index and does not include REITs, real estate investment trusts. A common question is why SCHD avoids REITs, especially since they offer higher dividend yields. The key reason? SCHD focuses on qualified dividends, whereas REIT dividends are classified as unqualified, which means they're taxed at your standard income rate, often at a much higher percentage. While REIT dividends may appear more attractive, the tax burden significantly reduces actual returns. SCHD's hidden advantage: tax-efficient cash flow. One of SCHD's biggest strengths is its steady dividend payouts, providing investors with a reliable stream of cash flow. And the best part, the taxes on these dividends are far lower than most other forms of income. As your investments compound over time, taxes can have a huge impact, making it crucial to focus on qualified dividends, which SCHD specializes in. Now, how does SCHD select which companies make the cut? It follows a strict screening process based on key eligibility criteria. A company must have at least 10 consecutive years of dividend payouts. It must maintain a minimum market valuation of $500 million, ensuring it's large enough to avoid excessive risk. The stock must have a 3-month average daily trading volume of $2 million, guaranteeing high liquidity for investors. Once a company meets these standards, it moves to the next phase of selection. From there, the remaining stocks are ranked by their projected annual dividend yield, and only the top 50% qualify for final consideration. SCHD's selection process: only the strongest stocks stay. After companies make it through the first 2 rounds of screening, they must undergo a final strict evaluation based on 4 essential financial measures. Only those with the highest overall rating secure a place in the fund. Here's the breakdown of SCHD's final selection criteria. Free cash flow to debt ratio. The fund prioritizes financially sound companies, ensuring SCHD remains a stable, low-risk investment. Return on equity, ROE. This metric reflects how efficiently a company generates profits for shareholders. Projected dividend yield. Since SCHD is dividend-focused, it selects businesses with strong dividend payouts while ensuring they are sustainable long-term. 5-year dividend growth rate, my personal favorite. SCHD looks for consistent dividend growth over time, rather than companies offering unsustainable, inflated payouts that might be cut later. This process helps SCHD steer clear of yield traps, stocks that temporarily boost dividends only to slash them later. When that happens, investors may be forced to sell, leading to tax implications and unnecessary portfolio adjustments. Instead, SCHD focuses on companies with reliable, long-term dividend stability, ensuring payouts remain steady for decades. This is especially important for anyone aiming to build passive income in the future. By the end of the selection process, SCHD consists of roughly 100 stocks, with a 4% cap per company, preventing any single business from overpowering the fund. Additionally, no sector can make up more than 25%, ensuring the ETF stays diversified and balanced. What's next for SCHD? Stay tuned. As we get closer to these upcoming changes, I'll keep you updated on which companies might be added and which could be on their way out. I've been digging into the data, and some analysts have floated the idea that Home Depot and possibly even BlackRock could be removed. On the flip side, potential new additions might include Procter & Gamble, Devon Energy, and perhaps even ExxonMobil, a move I would personally welcome. What's your take on this? Are you excited about the reshuffle, or is there a company you hope they keep in SCHD? Drop your thoughts in the comments below. SCHD's reconstruction is designed to enhance the fund's performance by focusing on companies with strong dividend payouts, robust financial health, and sustainable growth prospects. For investors, this means potential adjustments in dividend yields and exposure to different sectors. Your thoughts? What are your views on these potential changes? Are there specific companies you hope SCHD retains or adds? Share your thoughts in the comments below. Stay informed. To navigate these changes effectively, monitor updates, keep an eye on SCHD's official communications for confirmed changes. Assess impact. Consider how these adjustments align with your investment strategy. Engage with the community. Join discussions with fellow investors to gain diverse perspectives. Remember, stay informed, stay engaged, and let's continue this investment journey together. This video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor, so please always do your own research and consult a professional before making any investment decisions. If you found this valuable, tap that like button, subscribe, and I'll see you in the next video. Your journey to financial freedom continues, and I'm excited to be a part of it. Here's to your investing success. Profitable investing.